What if the biggest risk to your portfolio is that it's too American? Investors often assume that betting on the US economy is the safest play, but is that still true in 2025? Today we're comparing two heavyweights, VTI, the Vanguard Total US Stock Market ETF, and VXUS, the Vanguard Total International Stock ETF. Which one actually builds more long-term wealth in today's global economy? Let's break it down. Welcome to Asset Index, where we help you navigate wealth with data, not hype. Let's get into it. Part 1. Understanding the basics. First, let's define these two ETFs. VTI holds over 4,000 US companies, large cap, mid cap, and small cap stocks. It gives you full exposure to the US economy. Meanwhile, VXUS gives you exposure to over 7,000 companies outside the US. That includes developed markets like Europe and Japan, and emerging markets like China, India, and Brazil. So when you hold both, you basically own the entire world. But the real question is, should you? Part 2. Performance comparison. Let's look at how these ETFs have performed historically. Over the past decade, VTI has outperformed VXUS by a wide margin. Because US stocks, especially tech, dominated global markets. Think Apple, Microsoft, Nvidia, Amazon. These companies pulled massive returns. Meanwhile, international markets underperformed, especially Europe and emerging markets. But here's where it gets interesting. That underperformance has created a valuation gap. US stocks, especially large-cap tech, are now more expensive based on metrics like price-to-earnings ratio. International stocks? They're trading at a discount, meaning they might be due for a rebound. So while VTI looks better on paper, VXUS might actually offer more upside going forward. Part 3. Diversification. Benefits. One of the biggest arguments for VXUS is diversification. If your entire portfolio is in US stocks, you're not just betting on companies. You're betting on US politics, the dollar, interest rates, and economic cycles. But when you add VXUS, you reduce your exposure to any one country's economy. It's like owning different engines. If one slows down, another might pick up the pace. Historically, international stocks haven't moved in perfect sync with US stocks, which helps smooth out your returns over time. Part 4. Divide income comparison. Now let's talk dividends. As of 2025, VTI yields around 1.4%. VXUS yields closer to 3.5%. Why the difference? Many international companies pay out higher dividends than US firms, especially in Europe and Asia, where dividends are a bigger part of investor culture. So if you're building an income portfolio, VXUS adds diversification and yield. Just keep in mind, foreign dividends might come with withholding taxes, depending on your country and brokerage. Part 5. Tax efficiency and account types. Speaking of taxes, here's something most investors overlook. Because VXUS holds foreign securities, you may pay foreign tax on dividends. But if you hold VXUS in a taxable account, you might be able to claim a foreign tax credit that offsets some of what you paid abroad. VTI, on the other hand, is more tax efficient overall, especially in tax-deferred accounts like a Roth IRA or 401k. So think about where you hold these ETFs, because that affects your after-tax returns. Part 6. Risk factors to consider. Let's talk about risk. VTI is heavily weighted toward US tech giants, which have had a huge run. That means your returns are tied to the performance of a few big names. Great when they're up, but dangerous if they stumble. VXUS spreads risk across thousands of companies and dozens of countries. But that also brings risks, like currency fluctuation, political instability, and slower economic growth in some regions. It's a trade-off. VTI equals more concentrated risk. VXUS equals more global uncertainty. Part 7. Global trends to watch in 2025. In 2025, we're seeing major global shifts that could impact VXUS and VTI alike. Rising interest in de-dollarization, countries moving away from the US dollar. China's economic slowdown but still growing influence. Strong growth in India and Southeast Asia. Europe's energy transformation and green initiatives. Geopolitical tensions and trade realignment. All of this points to a more multipolar world economy. And that means having exposure beyond the US could be a smart hedge. Part 8. What the experts are doing. What do the pros say? Some of the biggest investment firms, like Vanguard, BlackRock, and Fidelity, recommend global diversification. Many of their model portfolios include 20 to 40% international exposure. Even Warren Buffett, who's long been bullish on America, has acknowledged the value of global investing. In fact, Berkshire Hathaway has made moves into Japanese trading houses and other global assets. Though if the world's top investors are going global, shouldn't you at least consider it? Part 9. Building a balanced portfolio. Here's a practical idea. 80% VTI, 20% VXUS gives you global exposure with a US core. 70% VTI, 30% VXUS adds more diversification without overcomplicating. Or 60% VTI, 40% VXUS for a truly global allocation. This way, you're not trying to pick a winner. You're building a resilient portfolio that adapts to global trends. Closing thoughts. So, VTI or VXUS? Truth is, you don't have to choose just one. They complement each other beautifully. VTI gives you the innovation and strength of the US economy. VXUS gives you access to the rest of the world, often at a discount. In 2025, going global isn't a luxury. It might be a necessity. And if you want long-term growth with smart risk management, a mix of both could be the most powerful strategy. Thanks for watching Asset Index, where we help you navigate wealth with clarity and confidence. New ETF breakdowns and wealth building ideas every week. Subscribe if that sounds like your style.